Want to know what I found out the other day?
What did you find out the other day?
Did you know the entire Earth is $315 trillion in debt?
Whoa.
Yeah.
What?
Who do they owe money to?
Bro, who are they getting money from?
It blows my mind that first off, you have everything on the planet here to live for free.
You literally have everything you need.
And then you invent a system that creates a deterioration of your own resources.
You created a store of value that's literally storing less and less value every day. Every day.
And you're increasing your technology, and yet somehow you still owe money to someone, and it's $315 trillion. There's not enough paper to print that much cash. What are they doing?
Dude, Earth is like the worst meme coin. It's the worst.
It got rugged.
Earth got rugged.
Total world GDP was estimated at $110 trillion last year, 2024. So about 1/3 the current estimated hard debt pile worldwide. Additionally, not counted here are the Western world's unfunded or unsafe war promise piles. They are both massive in the EU and USA respectively combined. So what's actually owed on paper is now well over $500 quadrillion in net present value terms, with a GDP of about 1/5. Yet we're supposed to sit here today with these facts and collect paper and digital currency units with full faith that they'll somehow store value in the coming decades, and we won't be rug pulled on a mass scale. The history of fading empires, especially during structural, transitional, resetting periods, illustrates we're better off owning bullion outright in aggressive allocations over most competing asset classes, and often in place of national or bank-issued promissory notes and or their alleged fungible digital units. Since 2022, government central banks have been doing so by buying gold bullion reserves in record size. Regardless of the distracted amnesia they think we suffer from, nor any legit U.S. gold reserve audit that's never going to happen, let's turn to Indian precious metals coverage and have a listen to the current head of one of the world's largest precious metals derivative trading desks, counterparty to about 1/10 of that $1/2 trillion precious metal derivative bet bar that you see here. Let's listen to his take about gold heading to 4,000 an ounce by the middle of next year, 2026, and how silver is bound to break into the 40s an ounce not long from now.
Okay, welcome back. As gold and copper prices came off their all-time highs, which they hit earlier this year, markets continued to react to tariffs and geopolitics. My colleague Manisha Gupta caught up with Francisco Blanch, head of Global Commodity and Derivatives Research at BofA Securities, began by asking about the recent correction in precious metals.
Look, we've been calling for $3,500 gold for the first half of this year. We got there, and we feel the market's going through a correction right now that could last a few months. Now we're still bullish longer term. We think longer term, maybe into the second half or into 2026, we'll breach $4,000 per ounce. But we're going through a correction because some of the extreme uncertainty that we've witnessed in recent months seems to be fading. Of course, it could come back. As we know, the Russia-Ukraine war, which was potentially heading into a ceasefire, into some form of peace deal, seems to be getting farther away from that. Also, we've heard about potential additional tensions between Iran and Israel, and then there is the negotiations around the U.S. budget in Congress. So I think we've hit a couple. We've gone very close to $3,500 gold a couple times, but to breach that level and keep moving up, we need some of this geopolitical turmoil, some of this policy uncertainty to creep back up again. Again, we expect it to happen into year end and into 26. But for now, we think it's unlikely we will move up in a straight line from here.
I want to talk about silver as well now, and a fifth straight year of deficit, but the prices haven't really moved with the fundamentals. The industrial demand also seems to have taken a bit of a backseat, not the same record numbers that we saw in 2024. How do you see the silver demand availability going forward, and what's your price sense?
Well, in silver, we are looking at $40 per ounce. We think silver is one of the better investments because, of course, remember, silver is half precious, half industrial. And the precious aspect of silver has been driving it higher. The industrial side has been taking a back seat. But this will eventually change. Of course, tariffs mean weaker trade conditions, and we had a pretty strong trade window between the fourth quarter and the first quarter of last year and the first quarter of this year, where investors were buying in anticipation of tariffs. Now we have the tariffs, so we're going to go into a slower period, which will last for a quarter or two, and eventually we will see another pickup in industrial activity. And again, if you are to model silver, the main drivers are, of course, the price of gold, because silver is largely a precious metal, but also what's going on with industrial activity. And right now, industrial activity is going to be weaker, so that's one of the reasons silver has lagged on the move up, the large upward lifting gold prices. It's really the weaker industrial backdrop we're seeing today. But we like silver. It's linked to solar panels. We still expect enormous investment in solar panels and in the electrification of everything. And we think silver plays a critical role. Remember, silver is the best conductor, the best electricity conductor in the world. So it's going to play a very important role. And we think going forward, once we go back into a more stable industrial activity environment, silver will shine again.
On the other side of this break, we're going to take a look at recent bullish breakout for the platinum price and the excellent underlying fundamentals for both it and the other white precious metal, silver. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates, and be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Protect your retirement with gold and silver IRAs. Learn more at sdbullion.com/IRA.
Silver and gold markets moved slightly down on this holiday shortened week to end May trading. The spot silver price closed just under $33 an ounce bid, and the spot gold price finished just below $3,300 an ounce bid, as the short price algorithms painted the monthly chart close tapes to just below round numbers. The spot gold silver ratio ended the week just below the century mark at 99. Well, technically, we need to see it fall below 97.5 before this bloated spot gold silver ratio spell might be behind us. In terms of year-to-date performance thus far for all three major precious metals, gold, silver, and platinum, each one is illustrating exceedingly bullish tendencies for the first half of this year thus far, with gold still leading the way on a percentage gain basis. All three major precious metals are well higher than normal year-to-date in percentage terms, and all, of course, are gyrating up and down along the way. While mostly positive outsized moves to the upside, there is a similar seasonal fashion in volatility when you look at the last 5, 10, or even 20-year rolling averages on these charts. Platinum recently captured some headlines and interest from the combination of its recently high price rally above 1,100 spot an ounce and increasing bullish fundamental factors and reportings. The price history of platinum is typical of commodity markets where too high prices in a bull market create a prolonged bear market and price consolidation era, until that particular element gets too cheap and re-rates higher, and typically does so in a fast fashion to the upside in multifold fashion. This may eventually prove to be the sixth time platinum busts out of a price consolidation and goes on another multifold move in spot prices to come. The Chinese have long memories going back to the commodity bull market they drove globally in the early 2000s, pre-global financial crisis era, where there were years when 1 ounce of platinum could afford you 2 ounces of gold. Now it takes 3 ounces of platinum just to garner 1 ounce of gold bullion, at least in relative ratio value terms at the moment. Last month, the Chinese imported 11.5 tons of platinum bullion, as many would-be gold jewelry buyers are now thrifting to platinum, looking at these ratios in value terms, likely seeing value in platinum over gold at the moment. That import figure is about 370,000 ounces of platinum, and that's just in April of last month, 2025, for China alone. That's over 98% of the entire underlying NYMEX Platinum Fractional Reserve Warehouse bullion holdings at the moment. This is currently happening in a global platinum market that's on track for a third year in a row of supply deficits. These charts on the left, that's China's gold versus platinum chart on the right, and that covers the full fiat currency era in the yuan or renminbi locally. The bid for industrial jewelry and investment demand for platinum, especially in China or in Asia, it's not going away. This is how bull markets in all precious metals get going in unison, by the way. Gold leads, eventually the white metals follow. Turning to silver, China continues cranking out massive solar panel infrastructure in record size to start this year yet again. Let's hear a Chinese English news channel explain further some silver fundamentals that were reported this last week of May 2025.
Silver is considered an excellent conductor of electricity. That's why it's printed on solar panels as thin wires running down each grid. And with growing interest in solar power globally, manufacturers are securing supplies of the shiny metal. According to the World Silver Survey, demand from the solar panel industry surged close to 140% over the past decade. But supply is struggling to keep up, with mine production down some 7%. While demand for silver is expected to stay strong, especially as it's widely used in circuit boards, a weaker economic outlook could change things.
If the global economy is weak, then they will stop making cars and make solar panels. So the health of the global economy will actually affect the price of silver. Whereas gold, usually even when the whole world goes to a downturn, the price of gold will not drop like 20% because those who buy it are maybe part of their portfolio. They're not going to change it unless they go into trouble.
Today, the gold to silver ratio sits at about 100, meaning 1 unit of gold is worth 100 units of silver. Market watchers expect that the price of silver will keep pace, bringing the ratio closer to the 40-year average of about 70. Already, the Singapore Bullion Market Association says it's seen more investments into silver over the last quarter.
Allocating gold as an asset class to the portfolio is a norm, but as price of gold is increasing higher and higher, some people are looking at silver as an alternative to be included into their portfolio.
The association adds that against the backdrop of global geopolitical risks, investments in precious metals like silver is one way of diversifying a portfolio and hedging against uncertainty.
Today being the final trading day of the month, the Twitter Silver Squeeze crew was out and about posting their recent bullion buys and making silly videos to entertain one another with. Of course, this chart provided by Craig Himke of TF Metals Report, it shows the closing price of silver today, and that's a perfect illustration of why the final trading day of the month makes sense, as the silver shorts consistently use algorithms to paint the tape artificially lower below round numbers, like for instance here, where it could have been a $33 an ounce candle for the end of the month, a few cents shaven off in the final low volume trading hour produced a $32 candle. So on it goes. The silver squeeze still trended on Twitter X today, and the silver spot price chart continues looking bullish long term. U.S. citizens and investors worldwide increasingly understand outsized derivative scam markets have allowed them to buy bullion at artificially depressed prices and relative values, at least for now. That won't always be the case because we're heading into an era of bullion shortages. Platinum and silver market deficits worldwide over the last handfuls of years combined are both warning us of that. Take advantage of this weekend's SD Bullion deals on platinum, gold, and silver bullion products while they last. That will be all for this week's SD Bullion Market Update, and as always to you, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.